Good morning, everybody. I hope everybody's having a great start to their week, and thank you for joining in for episode 2 of Rapid Fire. Like I've mentioned a couple of times now, we're going to try and keep it to 2.5 to 3 minutes, so let's jump right into it. So today what we're going to do is we're going to talk about mortgage insurance. This is something that I talked about in Jog and Talk way back in episode 4. Mortgage insurance and saving some money. But this is something that we do so much of, and we have so many questions on it, and you know, people are constantly asking how they can save money by doing this because I mentioned it so many times. So that's why I'm going to talk about it again today. So really, what the difference is between mortgage insurance and getting your own personalized term insurance is a lot of the times what will happen is the underwriting is done at the beginning when you're getting your own term mortgage or term insurance to cover, let's say, a mortgage or a debt. So what the good thing is about the underwriting being done at the beginning is that once the underwriting is done and your insurance is approved, as long as there is no fraud, at the time of death, it is paid out. Now, if the underwriting is not done at the beginning, what will happen is that the underwriting happens at the time of death. So they can actually, you know, if this is 10 years after you got the insurance, they can actually go back 10 years and say, well, listen, he wouldn't have been approved for it back then. We're declining it, return all the premiums paid, and the insurance is not covered. Does this happen? Yes. Have I seen a lot of it? No. Most of the time, it is paid out. I've only seen it twice in my career, but still, you don't want to be caught in that instance. The other thing about having your own personalized insurance compared to mortgage insurance or insurance with a lender is that, let's say you start off today with $500,000 mortgage. You get that coverage. 10 years down the line, God forbid, you or a spouse passes away. Now, if your mortgage has gone down, let's say to $250,000, the insurance that you get as a mortgage insurance through the bank or the lender, well, that bank or lender is going to get the $250,000. The mortgage is paid for, and that's it. However, if in the same circumstance you start off with $500,000, you have your own personalized term insurance covering that mortgage, well, what's going to happen is that $500,000 isn't sent to the bank, it's sent to your beneficiary that you picked. And that person's going to get not $250,000, they're going to get $500,000. So they can take $250,000 to pay off the mortgage and still have $250,000. That's a huge difference, especially since most of the time, it depends on the age and whatnot. The older you get, the more you're saving. But a lot of the time, you're actually paying less for your own personalized term insurance than you would for the mortgage insurance. So 10 years of payments where you're paying less, and on top of it, you're getting almost, you know, in this scenario, you're getting double of what you would have been getting if you went with the bank. So that is a huge difference. So you have to think about that. Also, the personalized term insurance follows you, meaning that if today you sign with one bank or with one lender for your mortgage, and then you decide in 5 years from now a renewal, or in 10 years from now a renewal, that you want to switch to another bank or another lender because their rates are better, well, guess what happens? You have to go through that process all over again to get mortgage insurance. The problem is now you're 5 or 10 years older, so the insurance is going to be that much more. Now, if you got your own personalized term insurance, let's say you got a term 20, 25, term 30 year to cover the original amortization period or payment period for your mortgage, well, it's going to follow you wherever you go. So it doesn't matter if you go from this bank to that bank every 5 years for the next 30 years, it won't matter. It's not going to cost you more. It's going to follow you and keep on the coverage, and away you go. So that is a huge bonus to think about. Like I mentioned not too long ago, your choice of beneficiary. You get to choose who is going to receive the money. When it's with the mortgage insurance with the bank, it goes automatically to the lender or to the bank for whatever's left over. So there's a big amount being missed out. So at least this way, you can pick the beneficiary. So that gives you full control over where the money is going, if it's following you, if you want to increase it maybe in the future, decrease it in the future, you have those options. Mortgage insurance through the bank, you do not have any options. And like I mentioned, a lot of the time, especially as you get older, getting this term insurance is actually going to save you a lot of money. I've had clients where we're saving over $100 a month in payments over $100 a month in payments. I've actually had a few over the years more than that. That's a lot of money. So this is a good way to save money. So anyways, there it is. If you want more information, you want to get a little more detailed or get more information on it, feel free to give me a call. It's no obligation. Listen, you give me a call, we can talk about it. If you're not interested or you're just simply calling, you're not going to get any pressure from me. That's not how I work. So reach out. You can PM me, you can email me, you can text me, you can call me, do whatever. So anyways, thanks guys. I noticed that I didn't keep it under 3 minutes. I'm trying. But anyways, at least it's broken down. So, listen, have a wonderful rest of your week. And I look forward to seeing you on Friday morning with Jog and Talk. Thank you. And we'll talk soon.